to be here. I used to be a big company guy, Exxon, Standard & Poor's, Equifax, and now I've joined Adviser Ratings as a fintech startup. So I'm doing some very important things differently. I've grown a beard. I look a little bit like Angus Woods now. I'm the founder. I've stopped wearing suits. And I realised too that if you're in a fintech, you've got to be a stage walker, which I've not really done before. I'm going to attempt this today. Apologies, as a novice stage walker. You either walk too much or you don't walk enough. Crossing that floor is a little bit like a little kid at a school crossing with traffic coming at them. It's a little frightening, but we'll give it a go. So today, and I better get a zapper, shouldn't I? I'll be able to change. That's why it wasn't working. So today's presentation is to take you on a very rapid scenic tour of the financial advice landscape as we have seen it this year, based on surveys we've done of advisors and based on our own observations by being sort of embedded in the market. We're presenting 7 findings from our report. And when you hear a little bit more about our business, particularly how the business has changed over the last year, you'll understand how we've got such a unique position in the market to have these insights. So a little bit on Adviser Ratings to start with. Firstly, a little bit of audience participation. I think I can see you. Hands up if you use Uber. Amazing penetration. Do you know your Uber score? Call it out. Someone call out a score. 5. Come on, who said 5? Rubbish. Who's on Adviser Ratings? Who's claimed their profile? Who's living on our platform? Not as many. Do you know what your score is? If you haven't been in recently, you probably don't realise we've also switched to an Uber score. So we've gone from percentages to 4.6, 4.7, 5 for that man in the corner. The business, if you're not familiar with it, we self-proclaim TripAdvisor for financial advice. All 24,000 advisors are on the platform, even if you've never been there to that website. We are building out that platform profile. Our mission in terms of the way we run the business is to work in the best interests of consumers and the best interests collectively of the industry. We've been doing a lot of work on the business and on the product, which is essentially the website, over the last year. We have 20,000 customer reviews now. We have 5,000 advisors who have claimed their profile, and those numbers are growing quickly. We've done a lot of work building out the publishing engine. We're actually moving to a self-publishing platform for advisors to generate more content, and we have a lot more content on the platform. We have rolled out, you'll see the brochures out on the stand outside, you'll see that we've launched a robo-register, 40-odd what we call business-to-consumer digital financial solutions. Everyone's got a different word for it, and the words can be very misleading at times. But we think that's been really important to build out the offering to consumers, to create more relatable content and to give them different ways of being serviced. We're also in the middle of a Series A cap raise, a lot of momentum behind the business, and we're going to the market for capital. And the 3 things I just wanted to mention briefly that we're looking to fund next year. Firstly, licensee ratings. We've been quite public about that. We have a white paper in market around how we're going to rate and assess licensees. And then we're rolling out a couple more services, and I think all of these services are effectively improving what we're offering you as an advisor and giving you more reason than ever to engage with our platform. 2 more things, a education hub or marketplace, which will be a one-stop shop for you to find FASEA approved bridge courses and CPD in one place. And then the last item is a vendor hub, which we'll actually be launching early in the new year. A place, again, a one-stop shop for you to go, essentially like an Amazon, to go and find information on all the suppliers to the industry. And that will become more relevant to you, I think, as we move towards a world of individual licensing, where the buying decisions will shift from the licensee increasingly to you. So let's get into the environment. It wouldn't be a conversation, a discussion about the financial advice landscape without a slide about regulation. Now, I'm not going to go into that detail. What I will say is, have we ever had a more tumultuous and revolutionary year in this respect than 2018? And the reality is we head into the start of the new year and there's so much that we don't know. There's so much that's uncertain. When I think about this landscape, I'm confident about three things. For next year, I'm confident that we're going to have a new benchmark and a new set of standards for education and ethical standards. FASEA may change. In fact, I do expect it will change again, but I know that's going to happen. I know that we're going to have the removal of grandfathered commissions and other forms of conflicted payment. I think that's absolutely going to happen. And we know we're going to have a very active regulator. They got pummeled in the Royal Commission, rightly so, and they're going to come out fighting. We've seen that already in some of the actions they've taken, Dover and similar things like that. So we're going to see a very active regulator. And then there are a bunch of things that we just don't know about. I guess every day about where these things might go. Things like vertical integration. There's been a lot of discussion about vertical integration being a bad thing. Some might argue that the banks are making a call on that by exiting wealth, but they're not splitting those assets up, are they? They're keeping them together. I'm not convinced that vertical integration will be broken. And I look to Europe as an example. It's actually going the other way. The banks aren't doing it, the fund managers and the life companies are. Massively vertically integrated and growing deeper into the value chain, buying platforms, buying advice businesses, buying robo-advice businesses. So vertical integration, the removal of commissions and life insurance, don't know. The move to individual licensing, not sure. We're setting up for that long-term future, but I don't know if it will happen. I don't know when it will happen. Clearly, other regulators might be introduced. We've got the code monitoring bodies coming out. Not sure how that's going to work with industry associations leading that charge. And then, of course, the big one, the big kahuna, of course, is a change of government next year. I mean, what happens if that happens? All of that stuff is uncertain. When I think about this industry too, I'm also reflecting on the way in which we're seeing the ownership of the industry changing. So clearly we've got the banks selling, moving out. We're seeing new entrants emerging. Obviously the Japanese coming in, buying up life assets. Japanese have a propensity to buy distribution assets as well. They've got big balance sheets, really patient capital, very low ROE expectations. They can buy higher and last longer. So watch for that space. But you've also got big names coming into the industry in other areas. Think about service providers, think about platforms, software technology, companies like Avaloq and Temenos, big Swiss bank service providers traditionally moving into wealth and making Australia central to their growth strategies. So let's move on to the first findings. Advisor transition. Now, this is a very boring slide with lots of numbers on it. I'll give you a moment to look at some of the headline numbers up there. But a better slide would have been a picture of buffalo racing across the plains in Africa, or bison in the tundra of Canada, migrating to warmer climates, because that's what it feels like. We've had 7,000 advisors leave the industry up to the start of this year. Massive growth rates of departures in the 3 years post-FOFA. And the next slide's going to tell you that people are moving at an even faster rate than that today. The traditional or typical, and there's no typical move, but the numbers show that the typical moves are advisors leaving the banks, jumping, IWF and AMP, jumping into the big independent licensees, then hopping into their own self-licensed boutique, sticking at that for a year or two, finding it very challenging, and then circling back into the big independents. That's a very well-worn pathway that's emerging And I think what that's creating is we're seeing sort of the growth of this sort of middle group of licensees that will number from 50 advisors to sort of 300, 400. I see that sort of number of entities growing. And then we've, of course, got the questions that advisors are asking themselves when they're moving, because they are moving at good rates. On the way out, obviously there's the question, the fundamental question is who owns the client? The Professional Planner newsletter, which I love reading, did a tremendous article. Tar and Sharp wrote a tremendous article about this a couple of weeks ago, exploring all those issues related to who owns the client and the commercial constraints and lock-ins that exist in licensees. So that's clearly challenging for advisors who want to move and take, obviously, their great customer base with them. Contractual constraints and non-solicitation clauses like that. And then, of course, on the way in to a licensee, I think there are a lot more questions in the minds of advisors about what licensee can I trust? What can I believe about what I see and read, about what they're promoting to me? And we're seeing a lot more reverse interest, or at least reverse interviewing going on, that advisors are becoming a lot more explicit about what they're looking for. And they're looking for different things. They're looking, traditionally they're looking for greater match in values. They're looking for that independence. They're looking for greater freedom and flexibility. They're looking for a business that's more agile and responsive to their needs. Price is an issue, but we find it's not nowhere near the top of the list of priorities in most cases. It's in there, but it's not an overarching requirement. And then you've got the business owners themselves. So the people who own practices, own books, are also somewhat in the lights at the moment. It feels like a buyer's market. Clearly the potential loss of grandfathering, the slow diminution of valuations and multiples are putting the wind up some owners. And yet they also know that it doesn't make a lot of sense to sell until post-royal commission when we've got greater certainty. So we've sort of feels like a buyer's market, but the sellers aren't letting go yet. So let's look forward. What's happening now and into the future. We've been public with these forecasts. They're quite dire. I mean, we say 14,000 advisors will leave the industry over the next 5 years. They represent $900 billion of wealth that they advise. And we say that a bunch of those clients are going to become orphaned as a result. Well, the truth is we're actually running ahead of those numbers at the moment. Since April, we are running at a much faster rate of advisors exiting the industry than that was built into that forecast of 14,000. Something like 20% of advisors, and when I say 20%, I'm talking 20% of 20,000 active advisors versus the 24,000 that are on the register, are leaving per annum, are leaving at the run rate since April. So you look at the issues down the bottom that sort of brings to mind. We estimate over 1 million clients that are going to be in transition. And the way you've set your business up will go a long way to determining whether or not those clients stay with the business that they were being serviced by in the past. If you've run your business in a way more like a portfolio where you've got clients working not only with their advisor but working more collectively with your overall business and knowing more people in your business, you've probably got a better chance of retaining those clients when the advisor who services them leaves the industry. Staff turnover. Most of the licensees out there are 2, 3, 4 person practices. They're micro businesses. And you lose one person out of a business of that size, massive impact. I'm running a small business. I've worked in small teams inside big companies, and turnover really hurts. So the ability to get on top of that and get ahead of it is going to be really important. A bunch of exclamation marks on the next icon there. There's just so many business impacts that sort of run through my head with things like this going on around the kind of client and business turnover, around staff turnover, around the way you set your business up to be able to deal with that transition. And then on the bright side, there are some great businesses out there. We estimate an average business is about $120 million of FUA based on our statistics. So again, for the buyers out there, for the licensees who are looking to acquire, there will be some good businesses in play. So let's talk about the institutional distribution model, which we see disintegrating. We've talked about the banks getting out of wealth. They're driving that significantly. And of course, advisors are also choosing to leave those large organisations, no matter who owns them, and go into small practice. And those big statistics in black sort of highlight that. We've also got this thing going on the right there, the green and black. You know, ASIC just keeps churning out more licensees. Extraordinary growth rates in the last 6 months, the last 12 months, the last 2 years. Extraordinary growth rates. Clearly, a licensing department living in another part of the world compared to the breach department, because that suggests that, and it worries me. And our licensee rating system, which we're rolling out, will be taking into account the fact that so many of the businesses that we would be rating will be 2, 3, 4-person businesses. We need to take that into account as opposed to rating a charter or something like that. Again, a bunch of issues down the bottom. Let's go through those really quickly. ASIC is going to be out there. They are going to be better funded. They are going to be hurting from the criticism they've received. They are using smarter techniques. They're interested in our rating system. They've acknowledged that may be something they will look at as well in terms of improving their surveillance. The value proposition for licensees, clearly licensees or dealer groups, let's maybe change the language now, because if the license shifts from the dealer group to the individual, then they're not called licensees anymore, right? They're dealer groups. I believe all those bits and pieces that dealer groups offer will remain important. Clearly they do. You know, you have to run businesses and they have the ability to scale those services. But I think increasingly dealer groups will be challenged to be modularised. At least you'll be buying modules from them. You might buy the whole lot, as you do today, but I think increasingly we'll see a modularised and fragmented service delivery, and the dealer groups will need to ensure they're delivering best of breed in each of those verticals. The reality is they won't, and they don't today, and so customers, you, will probably go and look elsewhere. The business strategy, if there's one sort of, it's appropriately sitting there in the centre of the slide. You know, with all this going on, more than ever before, you've got to have a business strategy. You are running businesses. You need a strategy, a long-term strategy. You need to understand how your business is going to be impacted by these changes and reforms. You have to have a real focus. You have to stand out from the crowd. We're going to talk shortly about being online and standing out, but you've got to have a business value proposition that stands out, that plays to your strengths, that you don't try and be all things to all people, that you find partners to help plug into your business to make you stronger while never sort of deviating from the core focus. The assessments are going to pick up. We're going to be doing more on you, more on licensees, a lot more on the suppliers that you're relying upon. We've got ASIC, we've got code monitoring bodies, we've just got a higher degree of assessment. And last but not least, vendors. Really interesting. So in Europe, and I look to Europe a lot to see what might come down the pipeline for us. In Europe, I think of MiFID II. MiFID II is a regulation in Europe which puts an obligation, appropriately so, on financial product manufacturers, let's think fund managers for now, an obligation on them to ensure they understand who sold the product and who bought the product. Was it appropriately sold and bought? And if the performance of the product is unsatisfactory or it's unsatisfactory in the hands of the consumer who bought it, then they're on the hook to some extent, financially on the hook. I think that will find its way out here eventually. It should. And what I'm seeing as I meet lots of vendors in my job is that they are starting to wake up to the fact that they do need to be more aware of the counterparty risk, to use a favourite term from Standard & Poor's days, the counterparty risk that licensees represent in their businesses, in their distribution strategy. Very different way of thinking for them. I don't think fund managers minded that much about who sold their products or how much were sold or who they were sold to. They just needed to change the product design to ensure more of it was sold, but now they'll need to think more about the distribution channel. I could spend hours on this slide, but I won't, simply to say that the whole industry clearly has to shift to another level. On average, across the industry, advisors are at an advanced diploma education level, and clearly the FASEA standards say you need to go one level higher across the board. So something like 70-80% of advisors have some kind of bridging course requirements. Obviously, we're getting more certainty about what that means now that FASEA is coming out with their instruments, and hopefully by the turn of the year we're going to have great certainty. And businesses can now get set up. You can understand what you need to do, but the licensees can also understand from a portfolio perspective what the nature of the transition is for their total workforce. Just to point out one thing down the bottom right, red flagging, as we are doing lots of work in the background in advance of rolling out our licensee ratings next year, and we're probably a year away from rolling those ratings out, we are going to be tweaking some of the logic behind the platinum, gold, silver, bronze ratings that you may have today. But the big effort is around the licensee ratings in around 12 months. We're doing a lot of work around a bunch of data sets to understand correlation, causation, predictiveness of some of the information. One little example of that is down the bottom right, is that looking across at all the licensees out there as an organisation, a collection of advisors, those licensees with overall lower education levels and high degrees of advisor mobility, in other words, by advisors who have hopped between licensees, you put those together and you have a very, very high degree of correlation, but not sure about causation, of correlation to a high number of disciplinary actions from ASIC, both at the business level and at the individual level. So that's an example of the kind of work, the analytics we're doing in the background to support some of the future state initiatives. Now moving on, 8 minutes, something pretty good. Moving on, suppliers. Here are 3 types of suppliers: investment admin platforms, financial planning software providers, and investment research houses. And what we're looking at here are net promoter scores as voted by advisors. Green being good, clearly, red not being good. If you look at those carefully, probably an observation would be that the incumbents are being sent a very strong message that they cannot rest on their laurels. We've got new challenges, agile, they're responsive to what you're wanting. It's unsurprising in some ways too, given the amount of movement of advisors out of the big institutions into smaller businesses, demanding to be helped and supported along the way. And again, the suppliers who are responding to that at least are being voted for. If the money is not flowing there yet, they're at least being voted for. Of course, the big guys will respond, as you would. I've lived in Exxon, Standard & Poor's. We were the #1 player. We were always being challenged. They will respond. We've seen BT Panorama obviously respond, make a pricing response. Price is an obvious way to respond. We've seen the emergence, my background from Standard & Poor's days with research. We've seen the emergence of all these little second tier, if it's a term I've heard, it's not my term, it's the term that's been given to me, second tier research groups, 1-person, 2-person organisations that are dealing with a lot of the IFA groups on their investment committees and doing the work that the Zeniths and the Morningstars maybe choose not to because they're working at the bigger end. So let's talk about online reviews, and hopefully I can make a case for more of you claiming your profile on advisor ratings and getting more active. So a lot of statistics here, but probably there's 2 to talk about. One is 90%. So these are global statistics. These are statistics drawn from TripAdvisor, Whirlpool, building website, building tradesmen websites, our website. 90% of consumers today in an online world trust an online review as much as they trust the recommendation that you give them or a friend or a family member gives them. And when you think about financial advice, only 15% of Australians get advice. So there aren't many recommendations coming through, are there? And still the consumer trusts what they see online as much as anything they might receive from a friend or family. Now, it's very easy to dismiss the power of a rating on you by a consumer who you're servicing, who you probably know is not particularly sophisticated. In fact, I'm actually doing some work at the moment on, and intend to publish some results, hopefully before Christmas, on the 20,000 reviews that we've got on our site. And one of the questions that we ask consumers right at the end is, how would you assess your financial literacy? Obviously, any kind of questions about self-assessment can be horribly wrong, but about the average score is about 6 out of 10. Men are understandably more confident and women less, but they're actually quite close. But about 60, my literacy is about 6 out of 10. So it's easy to dismiss the value of that feedback, but the thing is that people rely on it. I don't see, it's not the be-all and end-all, but it is an important statistic. And so it's important, and the other statistic was that 90% of consumers today will generally research a business online before they buy from that business. So when you take those two 90% statistics, you've got to be online. You've got to be loud and proud online. And today, in today's world, and particularly with millennials, if you're not online, you're essentially invisible. So I'd encourage you to claim your profile and fill it out and get some reviews. In terms of our business, here are some metrics. Tremendous momentum from the Royal Commission, absolutely extraordinary momentum, which is a good thing for you too. These are some of the KPIs we look at. Website reviews, all our statistics have doubled, 50% to 100% higher this year. Website reviews, leads generated that you receive for free, and quarterly client reviews. Our claim rates in terms of the number of advisors claiming their profiles are also going up, and typically the lead generation to those particular metrics. And then on the far right, as part of the work I'm doing at the moment, is looking at where people are being helped, where they want to be helped, where they're being helped, and how that matches up to the skill sets that you're saying that you have. So it's going to be an interesting piece of work. Keep moving. Very quick set of comments on technology. Again, we could talk forever on this. This is a bunch of our B2C robos that are on our register, including Sixpark. Ted's talking today on the program. A very eclectic bunch of services. Again, let's not get tied up with the language, but personal finance solutions, which can work very sympathetically with your business. And I think increasingly these firms are realising that they can help you, and I think you're starting to realise that these people can also help. You can help each other, and we want that to happen. We're trying to create not a demarcation between these two, but actually bring you together. And some of the tech we're doing on the site that will come out soon will show how we're showing greater connections between you. But as a statement about technology, I think our industry's got a long way to go to use technology. The focus has always been around efficiency, business efficiency, and there's nothing wrong with that. I'm an engineer, love business efficiency, standard processes, but the world's changing too. You need to keep doing that, and you need to get on with doing compliance. Compliance has shifted from let's sample a few of those SOAs from a year ago, and hopefully we passed, to 100% of SOAs tested real time. That's the technology challenge from a compliance perspective. And then last but not least, and these guys are showing the way, is that you've got to think about the customer. So the customer engagement, the customer experience is so important to be built into your tech and the way you service clients. And last but not least, an interesting little piece of work. This is a slide that on the right there, the opportunity, simply put, the opportunity is down the bottom right-hand corner. So here we've got, on the x-axis, we've got number of people, population of consumers per advisor. So the further right you go, the fewer there are advisors per population, and the y-axis is clients per advisor. So down the bottom right, we've got basically a bunch of consumers and very few advisors, and for the advisors who are in that little area, they haven't got many clients. Now, unsurprisingly, that the regions that are in that lower quadrant are unsurprisingly sort of lower socioeconomic groups and fringes of cities. But I think the challenge and the opportunity there is, so how do I service those people? How can I win those people over as clients. They're probably more likely to be mass market, low end of mass affluent, but there are different ways of doing that, of approaching them, reaching them, and it's food for thought. So that's it in terms of a final couple of comments, I guess. What we've learnt is there's a lot changing. We're not clear about what's going to be locked down by government and by legislation, post-Royal Commission, and we're not necessarily clear about what we're going to drive in terms of change in the industry. But the industry and the world is changing. Clients are expecting more of us. We are, I think, all together in understanding and knowing and believing that advice changes lives. Advisor Rating is at least trying to bring more consumers to you so that you can help them. Thank you.